Imagine you've finally developed a steady financial habit. You've been disciplined, moving money into your savings account month after month, until you hit a milestone, $10,000 in cash. It feels like progress until you look at the return. In a typical account earning 0.5%, that $10,000 generates just $50 in interest over an entire year. For comparison, the S&P 500 has historically returned an average of 10% annually. In that same year, the same amount of capital in the market would have grown by $1,000. The difference is starker over 20 years. A 1% savings account balance only reaches $12,200. Adding a 10% growth curve changes the outcome entirely. After 20 years of compounding, that original $10,000 grows to $67,000. This data illustrates that the primary wealth gap in society is created by the divide between those who save and those who invest. While saving provides immediate security, prioritizing absolute safety over 20 years ensures that you miss the growth necessary to build actual wealth. If the math of the market is so compelling, why do so many smart savers find it difficult to make the transition? The answer is psychological. A bank balance that never moves feels comfortable, while the short-term ups and downs of an investment portfolio can feel like an unacceptable risk. To bridge this gap, the first step is building a cash emergency fund. You need 3 to 6 months of living expenses saved before you ever put a dollar into the market. Step 2 involves splitting your money into 2 mental categories. One bucket is for safety, where the money stays liquid and still. The second bucket is for growth, where the money is expected to fluctuate over time. This emergency fund acts as a barrier. It ensures that when a surprise bill arrives, you don't have to sell your investments at a loss just to cover the cost. By strictly compartmentalizing your cash, you allow your safety net to function without it restricting your long-term growth. Step 3 is starting small. Investing just $50 or $100 a month helps you build the habit and get comfortable with market movement without risking your financial security. Many beginners fall into the trap of looking for high-complexity strategies like day trading or crypto speculation, which often leads to unnecessary stress and losses. A more effective approach is using index funds. These allow you to own a small piece of hundreds of different companies at once, lowering your risk through broad diversification. Even Warren Buffett has spent years recommending low-cost index funds as the most reliable path for the average person to build wealth. The success of this strategy is driven by consistent contributions and the power of compound growth over several decades. For example, investing $300 a month at an 8. When prices drop, your monthly contribution buys more shares of those companies at a discount. This lowers your average cost and positions you for larger gains once the market recovers. Ultimately, these two financial behaviors serve different functions. A savings account provides the stability needed to handle a crisis, while a portfolio provides the growth necessary to reach a point where working is optional. Moving your capital from a static bank account into a diversified portfolio changes its function from a simple safety net into a vehicle that builds your net worth even when you aren't working.